Have you heard the phrase dollar cost averaging? What does it actually mean? In this video, we'll look at the pros and cons of dollar cost averaging and give you all the information you need to decide if it fits in with your investing strategy. Dollar cost averaging, or DCA, is investing with a series of fixed amounts of money into an asset over time, rather than investing in one larger lump sum. So basically, you're getting into the market in smaller bites over time, instead of all at once in a single, bigger feast. This means generally you'll get the average price of the stock or asset you are investing in over this time period. Let's look at a simple example. Say you have $10,000 to invest in Vanguard's VAS ETF, which tracks the top 300 companies on the Australian share market. A DCA strategy could be to invest in 4 parcels of $2,500 over the course of a year at 3-month intervals. You put in your first $2,500 on January 2 at a price of $84.69. Another $2,500 goes in 3 months later on April 2 with a price at $65.38 after the COVID market crash. Your third amount goes in on July 2 as the price recovers to $76.61. And the final $2,500 is invested on October 2 at the price of $73.99. Across these 4 points, the average price you've entered the market in is at $75.17. Despite some volatility, this reflects the actual value of the ETF fairly closely during this entire time period. This is pretty much the entire purpose of dollar cost averaging. Now let's have a look at how this compares to investing the same $10,000 in a simple lump sum transaction. Timing now has a much bigger impact on your investment from the outset, as you're about to see. If you invest on January 2 at a price of $84.69, you are obviously well ahead of the DCA strategy we looked at before, which achieved an average price of $75.17. However, if you held off and instead invested on April 2, right after the COVID-19 downturn, then the strategy is well behind our earlier example. Your entire $10,000 investment is sunk into the market at a price of $65.38. Is your head still spinning? Are you still confused? Let's look a little bit closer at the pros and cons of dollar cost averaging versus lump sum investing. Dollar cost averaging is an affordable way to invest. You can do it on a regular schedule in smaller amounts, which makes it very achievable. Lump sum investors will need more time to accrue their deposits ready to hit the market. A DCA strategy removes the emotional component of investing. If you stick to your strategy and continue to invest no matter what the market is doing, you won't bail out and make emotional financial decisions, which can really hurt your portfolio. Lump sum investors may be tempted to try and time the market. The nature of dollar cost averaging means you'll average out the cost of your investment and avoid the absolute worst points in the market. Even if you do invest just before a huge downturn, you're only investing a portion of your funds and will have the opportunity to average out that cost over the longer term. Lump sum investing reduces this opportunity, particularly in the short term. One of the disadvantages of a DCA strategy is that it can result in lower returns over the long term compared to lump sum investing, despite the lower level of risk. This is partly due to the fact that lump sum investing allows you to get a larger amount of money into the market quicker, rather than averaging it out over time. As we've explained earlier though, this is not always the case. Dollar cost averaging will also attract higher brokerage fees, as you'll need more transactions to get your money into the market. This is the opposite for lump sum investors. At the end of the day, it all comes down to your own appetite for risk and your own investment goals. Are you disciplined, and can you refuse the temptation to make emotional investment decisions? Or do you prefer to be tied to a tight investing schedule and keep yourself on track in a gradual and responsible way? There's no right or wrong answer, it's all about what works for you. We hope this helps you understand exactly what dollar cost averaging is and whether it's right for you in your investing journey. Until next time.